Yeah, with the physical silver trade now largely bypassing local London, we looked at this last time. These same actors in silver futures are still exposed, well, not just silver futures, but also to unallocated spot silver, are still exposed to these Office of the Comptroller, OCC derivative bets, which are being targeted for delivery by the physical markets and have become increasingly difficult for the Fed to cover. And this is evident by way of declining open interest, or let's say the number of chips in play. Now, with the COMEX silver market paper settled liquidity, alongside producer financing initiatives, all leaching out into the Chinese physical exchanges where they're properly benchmarked.
And we'd be really surprised if 40 wasn't taken out in short order. As soon as we start seeing short covering, we would expect 50-odd, 53 to be the next staging point. And we'd be really surprised if 40 wasn't taken out in short order. As soon as we start seeing short covering, we would expect 50-odd, 53 to be the next staging point.
So given we've had so many questions on how these COMEX markets wash and rinse cycles work, I wanted to spend some time explaining the mechanics so others can mirror what every central bank is doing, ditching, depreciating unbacked fiat dollars for real money, gold, and understanding the limitations of these events so stackers don't get fooled into waiting for the kind of lower prices that Citi just capitalized on by taking everything that was on offer after they tricked CTAs into selling. Now, the Rob to Peter to pay Paul mark-to-market event will once again need to be paid back at higher physically determined prices, hence the higher stairstep. This was evident as the August contract rolled off the board. The spot premium to square these obligations had risen to $9.30. Now, as has been the case into every synthetic-driven short covering event since Basel III compliance, it's ultimately served to secure the next globally priced, physically driven higher stairstep. So in summary, the fulfillment of the December to August $59 EFP gap close that you just saw enabled officials to drag out non-compliance for just one more month. So they seek to sit on, what they're trying to do is seek to sit on the December 3,000 sweet spot. They want to keep it at 3,000. We've shown how for 4 months they were managing to keep it in a range. But this is their hope, is to try.
The only actor still trying to cap a rising gold price, which is the Fed. Now, if you remember, putting this into context, 2 months ahead of gold being reclassified as a physically deliverable Basel III NSFR first tier high quality liquid asset on the 1st of January, and this they covered just before that. It's basically 2 months ahead of that, in the know that gold was going to rise. So they covered all their remaining 500 tons of gold derivative bets. And they did that alongside every single global central bank, sovereign and bullion bank, ditching all their gold derivative risk and going long for their own books, all in tandem, anticipating higher prices. Goodness, even the outlier Citi has now reversed its bearish gold stance, now calling for 3,500 in November. If you remember, it was Citi that was calling for hundreds of dollar lower and failed to get it. Now, if you remember, we drew attention to these bets, and these are foreign exchange bets, unallocated foreign exchange bets that trade outside of the futures market. These bets were made by the Fed. Now, their agent bank, JP Morgan and Citibank, were the primary. Goldman has long escaped capping gold. So the two primary banks that we drew attention to, and if you look at the precious metals 5 years maturity bets, so JP Morgan and basically Citibank were the only two making derivative bets out for 5 years. So now, look at where we are now. They've covered. So it says everything. And as we've assessed in the past, these bets are undoubtedly linked to the 8,133 tons of rehypothecated US Treasury gold.
Has now largely escaped the LBMA stranglehold. Now, these same actors are having difficulty in containing silver. Now, the reason it hasn't spiked any higher is that savvy buyers, the controllers, are in China, and they're sitting back and letting the specs and the paper market guys do their thing. They've got control. They can let this run to 50 tomorrow. They can let it run to 100 tomorrow. But it doesn't suit them right now. But it's coming. Now, also, let's not forget, Russia is the 8th largest global silver producer and is estimated to produce about 1,400 tons of silver in 2025. Now, with the Russian central bank and the military complex recently diverting local production to stockpile silver, liquidity providers assess that this additional global offtake is not factored into the current supply-demand silver price, which is already in a deficit. And it is so disruptive, it tips the global supply deficit to force other competitive buying from China, India, and also from consumers who are going directly to the mines to produce, to source supply. Now, while spot silver is not Basel III compliant, it's important to understand this. Yes, it's not Basel III compliant, but it is a deliverable foreign exchange cross against the dollar, pound, euro, etc. And as with silver, and because silver supply is getting priced outside the LBMA's control, the Loco London Global Silver FX Fix, benchmarking the global physical supply demand settlement price, will have to rise to meet this fresh demand. And that's further going to drain Loco London's supply, which is already at critical levels. Now, the silver fix actually benchmarks a direct producer to end user price. And so any discrepancies are simply being arbitraged. And liquidity providers report continued accumulation of underpriced LBMA CME silver is currently now in the BRICS crosshairs, as it have been for some time, but it's stepping up. And very, very, very short term, silver under $38 is unsustainable.